Hello, savvy economists and financial aficionados. Welcome to another edition of Boss Economic World, where we unearth, sometimes literally, the hidden economic dramas behind the headlines. Today, we're venturing deep beneath London's bustling streets, not to find a new tube line or a trendy underground bar, but to explore a story that reads more like a modern-day treasure hunt than a routine financial transaction. Picture this: London's Central Line, shimmering vaults full of gold bars, and a logistical ballet orchestrated by a small team at the Bank of England. Grab your hard hats, or thinking caps, because we're about to dig into the economic intricacies, the absurdities of government management, and a satirical look at a global trade frenzy set off by nothing less than a tariff-tinted rumor mill. Every day, thousands of commuters on London's Central Line inadvertently brush past one of the world's most secure and historically significant storage facilities, the Bank of England's massive underground vaults. Nestled beneath the city's pulse, these vaults safeguard roughly $500 billion in gold owned by nation-states, commercial banks, and financial institutions. It's enough to make any economist's heart pound faster than a trader watching volatile futures. Imagine being on a daily commuter train and accidentally catching a live performance of gold being shuffled like a deck of cards by a dedicated, but decidedly under-resourced, team. Since January, these vault custodians have been working overtime, quite literally. They've been digging out gold bars, bar by bar, each weighing a hefty 12.5 kilos, to meet a surge in demand spurred by speculative bets that Donald Trump's America First tariff rumbles will soon envelop precious metals. What initially looked like a mundane custodial activity has morphed into a full-blown logistical fiasco that exposes deep-rooted inefficiencies in the bullion market. Let's break down this golden conundrum using our economic lens. Trading gold today isn't just about buying and selling, it's become an arbitrage exercise that marries high-frequency clicks with ancient, physical labor. Traders have been exploiting a price discrepancy reminiscent of a modern-day, buy low, sell high, strategy. In our scenario, sharp-eyed arbitrageurs are snapping up spot gold in London, at prices just below the record high levels, and selling corresponding futures contracts in New York. At one point, this calculated maneuver netted around $50 per troy ounce in profit on volumes that translate into hundreds of millions of dollars. When you think about it, that's like finding a hidden Easter egg in your cereal every morning, if that egg were made of solid gold. Unfortunately, the arbitrage opportunity has not been without its collateral damage. The sudden spike in physical gold movement has highlighted several underlying issues. 1. Logistical bottlenecks. The process of locating, moving, and shipping millions of troy ounces of gold bars isn't as simple as hitting send on an email. Vault custodians must physically locate each specific gold bar per withdrawal request, sometimes having to reshuffle entire pallets. This manual process, more reminiscent of a heavyweight workout than a modern fintech solution, has created a significant backlog. In January alone, about 8,145 bars were pulled from the vault, averaging around 370 bars per working day, leading to delays that can span weeks. 2. Physical constraints and geology. London City is built on clay, a factor that compels the Bank of England to stack gold only up to chest height to prevent structural damage. Compare this to other commercial vaults and you've got a clear case where geography is literally weighing down liquidity. 3. Over-reliance on a small team. The Bank of England employs a mere 15 highly vetted staff to process these transactions. When a surge demand occurs, these unsung heroes steel themselves to work overtime instead of employing a permanent workforce, mainly due to cost concerns and strict security protocols. It begs the question, why is one of the world's most pivotal financial institutions bound by outdated human resource models in the 21st century? For the interplay of public and private sectors, dealers at global bullion banks like JP Chase and HSBC rely heavily on the public sector staff at the Bank of England to facilitate these trades. This interdependence between public custodians and private profiteers underscores a systemic inefficiency. In effect, while traders are gleefully pocketing arbitrage profits, public employees, albeit well compensated with overtime, are caught in a dance of bureaucratic red tape and logistical nightmares. Now, no Boss Economic World edition would be complete without a satirical jab at government management, and in this saga, the irony is as brilliant as the gleam of gold itself. Critics could argue that the current predicament is not merely a consequence of market dynamics but also a reflection of governmental mismanagement that has allowed outdated procedures and resource constraints to fester. Consider this: while private vaults enjoy the luxury of modern technology and a more flexible workforce, the Bank of England, an institution that prides itself on centuries of reliability, has yet to adopt similar innovations due to bureaucratic inertia. Take, for example, the fact that even the bank's deputy governor for markets and banking, Dave Ramsden, had to contend with a lorry parked in the bullion yard, causing delays. It's almost as if, in an era where efficiency in logistics is heralded as sacred, just ask Amazon supply chain managers, our custodians of the nation's treasure are still wrestling with the age-old problems of urban congestion and static infrastructure. The move of more than 20 million troy ounces, worth about $60 billion, into New York's COMEX exchange since the U.S. presidential election marks the fastest movement of gold in over a decade. But instead of celebrating this high-octane trade, we should ponder the systemic implications. What does it say when the nation's central bank becomes the bottleneck rather than the enabler of economic progress? The answer lies in a mix of archaic operational policies, underinvestment in modern logistics, and a complacent adherence to tradition over innovation. Let's ground our analysis in some hard-hitting data and examples to illustrate the broader economic impact. 1. Leading indicators of global uncertainty. Gold has long been a safe haven asset, a role that comes to the fore during times of geopolitical and economic uncertainty. As U.S. gold prices hover just below a record $3,000 per troy ounce, the surge is more than just an isolated arbitrage opportunity, it's a clear signal of reduced confidence in traditional fiscal policies, particularly when influenced by impending tariff threats. Consider how this scenario mirrors the turbulence seen during the 2008 financial crisis and even the earlier stagflation episodes of the 1970s. 2. Comparative logistics. When global trading desks compare the efficiency of London's gold market with that of New York, the latter benefits from a more streamlined infrastructure where gold is recast swiftly into the format most suited for futures contracts. In contrast, London's reliance on a small, inflexible team and a geological constraint significantly hampers rapid adjustment to market shocks. A recent report by the World Gold Council noted that while the New York premium had narrowed to around $10 per ounce from a whopping $50, the backlog in London remains a persistent drag on the system's overall efficiency. 3. Market volatility and trade flow. The arbitrage window prompted by speculation around tariff impositions has shown signs of closing. Trade flows are starting to realign. When the tariff threat that propelled traders to buy spot gold in London dissipates, the rush of gold to New York might reverse. Nikos Kavalis of Metals Focus warns that if Asian gold consumption remains tepid and central bank demand surges, a whiplash effect could send recast kilo bars back overseas. Such cyclical adjustments expose the vulnerability of a market operating on thin margins and high-frequency switches between spot and futures. 4. Refinery squeeze. Companies like Arbitrage have been operating at full capacity. According to CEO Robin Kalvenbach, orders for recasting into kilo bars have gone through the roof in December and January. However, increased demand for spot metal has driven financing costs up sharply, pressuring the refinery's margins. This phenomenon underscores the interconnectedness of physical markets and financial derivatives, a dynamic that, if mismanaged, could magnify systemic risk. 5. Comparative global practices. When international markets look at London, they might wonder why the world's largest gold market isn't leveraging automation or even a temporary expansion of its workforce during crises. For instance, the way the Chinese gold market has integrated technology and flexible labor to boost efficiency stands in stark contrast. This comparative failure highlights a broader issue. In an interconnected global economy, clinging to outdated practices has real costs, not just in euros and pounds, but in lost opportunities for economic growth and innovation. So what's the take-home message for our audience of regular financial news followers and industry professionals? The frenetic activity in London's gold vaults isn't just an isolated hiccup in logistics, it's symptomatic of a broader economic malaise where government institutions and antiquated management techniques collide with the rapid pace of global financial innovation. The arbitrage opportunity, the physical limitations of stacking gold on clay foundations, and the reliance on a minuscule team of overworked custodians all speak to deeper systemic issues that can no longer be swept under the rug. At a time when global trade is increasingly subject to unpredictable policy shifts, be it through unilateral tariffs or protectionist moves, a failure to modernize key financial infrastructure is like choosing to drive a vintage car on the Autobahn. Sure, it has character and historical value, but when turbocharged competitors zoom by, you're left in the dust, or worse, stuck in a bottleneck. Consider the following policy implications. One cannot help but wonder whether a much-needed infusion of technology and process automation at institutions like the Bank of England would not only expedite physical movements of golden assets but also ensure that these controls no longer become the weak link in the global financial chain. The rigid, cost-conscious approach that prevents the hiring of temporary or additional staff during sudden surges in demand must be rethought. Financial markets operate on a 24/7 basis. Why should the custodians of our national treasure operate like workers stuck in a bygone industrial era? The arbitrage that traders exploited was not purely a stroke of genius, it was enabled in part by a lack of coordination between different nodes of the gold market, London's physical vaults versus New York's futures contracts. Governments and regulators should consider integrated policies that minimize such frictions while ensuring that financial innovation is not stifled by archaic practices. Let's put this in context with some of the latest global economic trends. In recent months, inflation has been a major talking point in economic circles, from the stretched supply chains in the post-pandemic recovery phase to the volatile performance of commodity markets. The gold market incident is a microcosm of these broader issues. Just as the global supply chains faced hiccups due to pandemic-related lockdowns and labor shortages, the sudden demand for physical gold has exposed vulnerabilities in the logistics chain. The heavy reliance on manual labor in moving 12.5 kilobars only underscores how physical asset management still has a long way to go in automation. The speculation around tariffs, much like the trade disputes we saw during previous US-China trade wars, reveals how market sentiment can pivot sharply on policy rhetoric. This episode is a reminder that while digital transactions occur at lightning speed, physical assets require a human touch, one that is vulnerable to the same bureaucratic inertia that slows down government responses. Global financial institutions, from banks to private vault operators, are caught between maximizing arbitrage opportunities and managing risks inherent in physical asset trading. The market's rapid adjustment, illustrated by the eventual narrowing of the price gap from $50 to $10 per ounce, demonstrates that while arbitrage opportunities may be temporary, the underlying demand for efficiency is permanent. In conclusion, the unfolding drama at the Bank of England's vaults is a stark reminder of the fragility of even the most revered institutions when faced with sudden market shocks and outdated operational protocols. Here we have a case study that intertwines global trade, logistical constraints, policy uncertainty, and the unyielding weight of tradition, all set against a backdrop of gold bars being unearthed like relics of a bygone era. This saga serves as both a witty anecdote and a cautionary tale. It challenges our cherished notions of stability in public institutions and invites us to question whether adherence to historical practices might be hampering progress in a world that refuses to stand still. The gold may be timeless, but the systems that manage it must evolve if we are to avoid a future where every rush of economic activity is met with a frenzied scramble, bureaucratic delays, and the occasional lorry blocking a bullion yard. So, next time you're riding London's tube and you hear that mysterious, almost musical hum echoing from the depths beneath the Bank of England, remember, you're witnessing not just the rumble of an arriving train, but the heartbeat of an economy in transition, one that is as golden as it is jaded, as promising as it is paradoxical. And as always, here at Boss Economic World, we'll keep our eyes on the data, our wits sharp, and our critiques as biting as the edge of a freshly minted gold bar. Keep your portfolios diversified, your humor intact, and remember, in economics, sometimes the real treasure isn't the gold itself but the lessons we unearth along the way. Stay golden, folks.